Welcome to our next episode in Business Basics, Investing Vehicles. So we're going to talk about three different types of investing vehicles. And investing vehicles are simply put ways for an investor to invest money that go above beyond just using E-Trade or using Robinhood and using these own personal investment services. If you're the average investor who doesn't have the financial knowledge or expertise to invest, yet you still want to make money, then here are several options for you. So the first option is mutual funds. And mutual funds are pools of money collected from investors to invest in securities. So as an investor, you give your money to a mutual fund company, and that company then hires these professional money managers, and these money managers then pick investments for you based on your needs, your type of risk, etc. And so some of the famous or most well-known mutual fund companies are Vanguard, Charles Schwab, and Fidelity. So actually, let's go here and click on the link and see a list of Vanguard's mutual funds that they have. Here are their funds. They have mutual funds and ETFs. We'll discuss ETFs later. So here they have total market index funds. They have some US bond funds here. And we can see that some are tax exempt. Others here are for inflation, intermediate term. Then we see some balanced funds. Then US stock funds. So 500 index admiral shares, small cap index admirable shares. So these are going to be stocks that are lower valued, that are predicted to have higher growth than US growth, so higher valued stocks. International stock funds. So Vanguard is, as we mentioned, the most well-known mutual fund provider in America. Okay, so our next sector is exchange-traded funds, or ETFs. So ETFs are stocks or collection of stocks that follow an index. So let's say that you really like the oil industry or the energy industry. So some of your big names are Chevron, Exxon in oil, also some others. So let's say you really want to invest in one of those companies. How do you pick one out of all those great companies that we mentioned? Because those companies are going to be competing against each other. Chevron may not return the same amount as Exxon does in the course of a year. So how do you pick which one of those stocks to invest in if you can only afford one? So this is where ETFs come in. ETFs allow you to skip that competition aspect and invest in this sector altogether. So you can invest in just one stock, and that one stock represents the entire oil industry, or it just represents the top players in the oil industry. Regardless, though, it allows you to skip over that competition aspect. So for example, in the financial industry, there's XLF, which represents the entire financial services sector. So rather than picking just JP Morgan, Bank of America, Goldman Sachs, you can pick the entire industry and not have to worry about JP Morgan and Bank of America competing against each other. And similarly, you have with the home building industry, XHB. So it's how that stock does could be a representation of how the home building industry is doing or the housing market. And then also you have the safe haven of gold, GLD. So hedge funds are final type of solution we're going to look at today. Hedge funds are privately owned companies that invest their investors' money into financial instruments. So these actually work very similar to mutual funds, where you as an investor give your money to a company, that company then hires professional money managers to make money for you. Now, the difference between hedge funds and mutual funds is the clients of hedge funds and mutual funds, or the investors, the people who put money into hedge funds and mutual funds. So with mutual funds, they generally tend to be for the average investor who is of a moderate to lower income status, whereas hedge funds are for your wealthy and institutional clients. So just look at the examples: Bridgewater Associates, JP Morgan Asset Management, Two Sigma, and BlackRock. All these companies and all hedge funds are marketed specifically towards your wealthier clientele. So hedge funds tend to be run by Wall Street professionals, actually, and it's created mainly to outperform the market. Okay, so let's recap. So we have two similar types of funds, hedge funds and mutual funds, where investors provide their investment to a company. That company then hires professional managers to make money for those investors. Now, how do hedge funds and mutual funds differ? Hedge funds are for wealthy clientele, and therefore they're going to pursue different, more high tailored strategies, whereas mutual funds are more so for the average investor. Then ETFs. ETFs are to avoid competition for an investor and allow an investor to get an entire industry or portion of an industry. Alright, thank you for watching the video. If you liked that video, please visit our website businessbasics.online, and also remember to hit the subscribe button and give this video a thumbs up. Thanks for watching.